Welcome back to TheStreet.com TV. Here is Wall Street Confidential with Jim Cramer, as always. Hi, Jim.
Hi.
Recently, you wrote about MasterCard, and what I found interesting was you bring it up in the sort of the context of mixed retail reports that we're seeing.
Right.
And you say, look, forget that. Don't focus on that. Focus on MasterCard. So tell us a little bit about that.
Well, I mean, I think that this is a heavily shorted name. It's continually to be heavily shorted because people just feel like the American consumer is slowing down. The way to play it is to bet against the credit card company. What I think people don't recognize is that there's a tremendous secular growth in going from cash, check, to credit card. And the winner of that is not American Express. It's not any of these, the Target card, which is a MasterCard derivative. But it is MasterCard. And when you think of a secular growth trend, it trumps anything cyclical. Plus, I mean, MasterCard makes a little money per transaction. But what it really makes is, like, when you get a new customer, it's fabulous for them. I think that the bears they were keying on three things. One was that the American consumer is going to slow down. And what they misjudge is that it's a play on cash and worldwide, not just in America. Two was that these lawsuits were going to hurt them, but there's been a couple rulings that make it so the lawsuits are much less likely. And three is that they felt that MasterCard wasn't going to be able to raise fees. But that was just a presumption that I think is gravely mistaken. I think they can raise fees. This is a stock like Apple, where the revaluation is so stark versus what people thought of it before. And I've been working on this revaluation theme on realmoney.com, which is that you'll have these stocks that people think are worth X, but the growth turns out to be accelerating. So they're really not just worth 1X or 2X. They're like worth 3X. I mean, MasterCard was at 50 and then goes to 150. Now, some of it is on the backs of the shorts who just keep putting it out and keep having to cover. But when you look at anytime you have a secular trend, which is toward fashion and phone and fashion and iPod, which is toward credit versus cash and check, you can't fight it. You can't fight it with a cyclical analysis that people won't pay $600 for the phone, that people won't shop as much. Because the secular growth is always more important to Wall Street than any sort of cyclical concern.
So back to your point about fees, is that basically why they can raise fees? Is because the consumer is just going to constantly be out there shopping? Going to get that
yes, they can
iPhone?
raise fee. I mean, it's a scarcity issue. MasterCard also reminds me of Chicago Merck and SIBO, which is always raising fees. I mean, Wall Street loves it when you can raise fees. One of the reasons why the New York Stock Exchange is not doing well as a stock is they're cutting fees. So the perception is if you can raise fees, good. If you cut fees, bad. And I can't disagree with that perception. It's very important. Wow. Although, and as you know, I stopped defending New York Stock Exchange. I just want it to go lower so I can buy more.
Well, there you have it. Jim Cramer on Wall Street Confidential at TheStreet.com TV. Thank you so much, Jim.
Thank you.